The Emerging Issues Task Force, or EITF, met in September 2014 to discuss several open issues, including Issue 12F, which deals with the recognition of a new accounting basis in certain circumstances, commonly referred to as pushdown accounting. A final ASU on this topic was issued in November 2014. I'm Dan Amat, Senior Manager in KPMG's Department of Professional Practice, and I'm happy to be joined by my colleague Arturas Spencer, also a Senior Manager in our Department of Professional Practice, who's part of a team actively following EITF issues. Over the next few minutes, we'll provide you with a summary of the background and current status of this EITF issue. So Arturas, use of pushdown accounting has been around for some time. Can you give us a little background and then scope of what the task force took on here?
Sure. So pushdown accounting is really about an acquired entity adjusting their books and records to reflect the basis of the acquirer. So consistent with purchase accounting, the acquirer's basis and assets and liabilities are typically recorded at fair value, and then those values are pushed down to the acquired entity. Historically, U.S. GAAP have very limited guidance as it relates to pushdown accounting, and some of the more widely used guidance was that issued by the SEC. So the SEC provided some guidance that outlined 3 scenarios within Topic 5J and D97. So it's important to note here that the SEC rescinded Topic 5J on the same day that this ASU pushdown accounting was issued, but it's important to highlight these rules as part of this podcast. So in situations where an acquisition resulted in 95% or more of an entity becoming acquired, pushdown accounting was required under the SEC's guidance. And then in instances where an acquisition of 80 to 95% of an entity occurred, pushdown accounting is permitted. And where less than 80% of an entity is acquired, pushdown accounting was prohibited under the SEC's guidance. Now, obviously, the SEC's guidance is not mandatory for non-registrants, so there is inconsistencies in practice as relates to pushdown accounting for non-SEC registrants. And additionally, in situations where registered entities have acquisitions in that 80 to 95% range, where pushdown accounting is permitted but now required, inconsistencies in practice also existed. So really, as a result of these inconsistencies and the lack of guidance, the EITF began looking at this issue, and specifically as it relates to when and how pushdown accounting should occur, whether it should be required, optional, or prohibited.
Okay, now we have a little background on the issue. Can you provide us with maybe an example of how pushdown accounting would work in practice?
Yep, sure thing, Dan. So why don't we assume there were 2 companies. One is Purchase Co., and Purchase Co. is acquiring Little Co. Now, at the date of acquisition, Little Co.'s fair value is $72 million. Purchase Co. is going to acquire 70% of Little Co., and its equity is consistent with the consideration paid of $50 million. Now, immediately prior to the acquisition, Little Co.'s book equity was $10 million, and subsequent to the acquisition, Little Co. plans to continue to issue separate financial statements. So if pushdown accounting were applied upon a change of control event, in our example here, Little Co. will be required to write up their assets and liabilities to that acquisition date fair value of $72 million.
Okay, but wait a second. You said that the acquisition was only of 70% of Little Co., so why are we applying pushdown accounting here?
Yep, that's a good observation. So this is a difference from the SEC's previous guidance, at least from a public company perspective, where an acquisition of less than 80% pushdown accounting was prohibited. But irrespective of the level at which pushdown accounting is applied, this concept will be the same. And so while this example is not consistent with the SEC's legacy guidance, this is ultimately where the EITF and the FASB and the SEC landed. So with that, why don't we talk a little bit more about some of the recent events as it relates to pushdown accounting. So this particular issue of pushdown accounting has been discussed at several EITF meetings over the past couple of years, and this issue dates back well before then. So as you may recall, at previous EITF meetings, several different alternatives were discussed, But ultimately, at the EITF meeting in March of 2014, the task force reached a consensus for exposure where pushdown accounting will be optional for all acquired entities following a change in control event. This consensus was exposed at the end of April, and the comment period ended on July 31st of 2014. The feedback from constituents was discussed during the September 2014 meeting, where a final consensus on this issue was reached. And as Dan alluded to at the onset, the FASB approved this final consensus and issued an ASU 2014-17 in November of 2014.
So, Arturis, why don't you spend some time discussing the highlights of the new standard?
So the final standard includes the following guidance. The real key concept behind the ASU was carried over from the consensus for exposure, where pushdown accounting will be optional upon a change of control event. Under the standard, the election to apply pushdown accounting can be made at the transaction level rather than being an entity-wide policy election. Entities that elect to apply pushdown accounting following a change of control event will be required to disclose sufficient information, generally consistent with the requirements in Topic 805, and that's just to make sure that users are able to evaluate the nature and effect of pushdown accounting. Consistent with the exposure draft, under the standard, an acquired entity would recognize acquisition-related goodwill in its separate financial statements. Bargain purchase gains that result from the acquisition would not be recognized in the income statement of the acquired entity. Instead, bargain purchase gains would generally be recorded in equity of the acquired entity. Acquisition-related debt incurred by the acquirer would only be recognized in the separate financial statements of the acquired entity if that entity is required to do so under other U.S. GAAP, for example, joint and several liabilities. If an acquired entity determines that it does not have to recognize that debt as a liability in its separate financial statements, no additional disclosures related to debt will be required. And then just to touch on a couple more topics that were included in the final standard. The final standard clarified that when an entity and its subsidiary were both acquired by a controlling parent, each entity would have separate election whether or not to apply pushdown accounting.
So just to clarify that last point, in this situation, if the acquired parent makes the election not to apply pushdown accounting, would the subsidiary still have the option to apply?
Yeah, that's correct. And if the acquired parent elects to apply pushdown accounting, its subsidiary would not have to apply pushdown accounting. And then just the last item that I'll go over is the guidance on pushdown accounting would apply prospectively to new transactions, and entities may elect to apply pushdown to a prior transaction if it's determined to be preferable. But on the flip side, if an entity elects to apply pushdown accounting, that decision is irrevocable. And then as it relates to effective date transition, the guidance on this ASU is effective upon issuance. One last point I might highlight here, Dan, before you close out this program is that since the SEC rescinded SAB Topic 5J, this standard is applicable for all entities. While D97, which deals with pushdown accounting and collaborative arrangements, has not formally been rescinded, the current expectation is that it will be rescinded after the FASB and the SEC go through their due processes.
Okay, thanks, Arturis, and thank you for listening today. For additional podcasts and other leadership publications on current EITF issues and latest information on other financial reporting topics, please visit the Financial Reporting Network by using the web address on this slide.